Welcome to EnrichMinds.com and our session on measures of investment performance. Before we get started with making investments, we must understand how to monitor our investments and how to compare different investments. If we give our monies to someone else to manage, like a fund manager or an investment advisor, you must understand these measures to evaluate whether they are doing a good job managing your money, or are you better off somewhere else or even doing it yourself. We shall learn about the three most commonly used metrics, their use cases, and their limitations. First, ROI stands for return on investment. Second, CAGR stands for compound annual growth rate. And third, IRR stands for internal rate of return. We shall study each one and their limitations in detail. First, let's look at ROI, or return on investment. Return on investment, or ROI, is a popular profitability metric used to evaluate how well an investment has performed. ROI is expressed as a percentage and is calculated by dividing an investment's net profit or loss by its initial cost or outlay. ROI can be used to make apples-to-apples comparisons and rank investments in different projects or assets. ROI does not take into account the holding period or passage of time, and so it can miss opportunity costs of investing elsewhere. This is the biggest disadvantage or limitation of using ROI. The limitations of ROI. The return on investment, or ROI, does not account for time. Two investments would display the same ROI despite being wildly different in holding period. It does not consider time value of money, or TVM. For example, an investment of $1,000 yields an outcome of $2,000 after 2 years, while another investment of $1,000 yields an outcome of $2,000 after 20 years. Clearly, the second investment is inferior to the first, but the ROI of both investments is the same. The compound annual growth rate, or CAGR, is the smoothed rate of return, or ROR, that would be required for an investment to grow from its beginning balance to its ending balance, assuming the profits were reinvested at the end of each period of the investment's lifespan. The compounded annual growth rate, or CAGR, is one of the most accurate ways to calculate and determine returns for anything that can rise or fall in value over time. CAGR can be positive for gains or negative for losses. Investors can compare the CAGR of two alternatives to evaluate how well one stock performed against other stocks in a peer group or a market index. CAGR is expressed as a percentage. The biggest limitation of using CAGR is that CAGR does not reflect investment risk. It accounts for time, so it is a better metric than ROI, but is silent on the risk of the investment. Let's now understand how to calculate the CAGR of an investment. We need three inputs. First, the starting or beginning value of the investment. Second, the ending value of the investment. And third, the number of years. If the holding period is in months, we must convert it to months as a fraction or a decimal. CAGR equals EV divided by BV, all in parentheses, raised to the 1 over n minus 1, where EV equals ending value, BV equals beginning value, and n equals number of years. You can use a calculator or an Excel file to calculate the CAGR. Look at the 3 investment profiles over the same 5-year period. Clearly, one investment, A, is the most stable and least volatile. It is the smoothest of all the return profiles. Investments B and C are way more volatile relative to A. But all 3 investments will have the same CAGR. So CAGR does not reflect the risk of an investment. The third measure is the IRR, or internal rate of return. The internal rate of return, or IRR, is the annual rate of growth that an investment is expected to generate. The IRR is calculated using the same concept as net present value, or NPV, except it sets the NPV equal to 0. I hope you remember the NPV concept from our session on time value of money. To recollect, the present value of a future cash flow, say FV, is equal to FV divided by, in parentheses, 1 plus R, close parentheses, raised to the power of n, where n is the number of years between today and that future date. IRR is ideal for analyzing capital budgeting projects to understand and compare potential rates of annual return over time. IRR cannot be easily calculated analytically, and instead must be calculated iteratively through trial and error, or by using software programmed to calculate IRR, like using Excel. Using the formula, one would set NPV equal to 0 and solve for the discount rate, which is the IRR. The initial investment is always negative because it represents an outflow. Each subsequent cash flow could be positive or negative, depending on the estimates of what the project delivers or requires as a capital injection in the future. So, in summary, the key takeaways from today's session are: first, no measure is perfect. We have learned 3 such measures today. The most important distinction between CAGR and IRR is that CAGR is straightforward enough that it can be calculated by hand. The concept of CAGR is relatively straightforward and requires only 3 primary inputs: an investment's beginning value, ending value, and the time period. IRR considers multiple cash flows and periods, reflecting the fact that cash inflows and outflows often constantly occur when it comes to investments. And second, as always, make sure you understand the limitations of any measure you use before making investment decisions. Thank you for your time. Until next time then, stay enriched and strong.